The reason the stock market goes up and down is because really big investors come in and they buy a lot of stock. Now they can do this for a bunch of different reasons. It can be like the 10Qs or the 10Ks, the quarterly reports. Maybe they did a bunch of research on the company, or the company's about to come out with something. There's a million reasons why a big investor might buy into a stock. Well, day traders and swing traders pick this up using scanners. They can see when these stocks are about to jump up. A good analogy would be big investors are like freight liners or cruise ships, massive ships moving a lot of stuff, they're making really big wakes in the water. Day traders and swing traders are more like speedboats and jet skis. They come in, they jump up and down on the waves, they have fun, but then they are gone pretty quickly and they don't go very far. Except that the waters are also infested with sharks and filled with rocks, and if you fall off, you'll probably die. So, day traders can see when these stocks are about to go up. They have what's called scanners that will pick up these stocks that are about to fluctuate really high. If they pick them up in time and analyze the data, they will buy into the stocks right as it breaks the resistance line. And when that happens, the stock usually skyrockets. And the day traders and the swing traders will ride these waves up and then sell out at the top and make profit. That's how they make money. Now, if you're wanting to day trade, there's two things you really need to understand. That's volume and float. Now, volume is the total amount of shares being sold in a given day or a given moment. Float is really important to know because it allows you to understand how much risk and reward you're going to get when you take a trade. Float is the total number of stocks out in the market that you can buy as a trader. Now, it's different from the total share cap of a company. It's not the same. There'll be people in the company that own shares, but they usually don't trade them a whole lot, and that's not calculated in the float, so it is different. The reason float is so important is because the less amount of shares there are in the market, the more volatile that stock will be, the more it will jump up in price or jump down in price. So, for example, if there's 10 million shares floating in the market, and if all of a sudden the volume of the stock goes up to, say, 500,000 or a million, that's 10% of the total stocks. That stock is going to be moving a lot. Versus, say, a company like Apple, who I think has over 1 billion shares out in the market right now. So, if there's 1 million shares being moved in a given day, that's less than 1% of their total stock. So that stock price is going to barely fluctuate, and it's going to be a major risk for not a lot of reward. So what day traders and swing traders look for are stocks with low float and a lot of volume being moved.